Welcome to LR Reports. This channel focuses on institutional research that I've personally reviewed. As a fund manager and family office analyst, my role is to filter through a large volume of research and focus only on what truly matters. AI helps structure and deliver the content efficiently, but the selection and interpretation are human.
Welcome to The Critique. Today we're looking at a Goldman Sachs research report on Walmart.
That's right. It's dated January 13, 2026.
And the context here is the ICR Conference, specifically a meeting with their EVP of AI, Daniel Denker.
In short, the report is really digging into Walmart's pivot to AI and whether it can boost sales and profit while consumers are still so focused on, just affordability.
And this is a really standout piece of work.
It is, I think, because it does that critical first thing. It differentiates Walmart from the consensus view.
Which is, what? A steady defensive value play?
Exactly. And this report just flips that narrative. It's framing Walmart as a growth and profitability story, all driven by technology.
And that shift is really the engine of the whole analysis.
It is. So our critique today needs to focus on that. Does the report build a strong enough case to sustain that higher narrative and, the higher valuation that comes with it?
That's the perfect way to frame it. Because the analyst is asking the market to accept a pretty significant premium.
A huge premium.
We're talking an EV to EBITDA multiple of 21.5x for 2026. For a retailer that's historically been all about value.
Right, so let's start there. The first thing is the report needs to really strengthen that narrative bridge.
The bridge between what and what?
Between Walmart's traditional moat, its operational strength, and this new assumed growth valuation from AI.
I see. So it currently has two strong arguments, but they feel a little separate.
Kind of isolated, yes. You have the defensive argument on one side, gaining market share because they're affordable.
And then the AI growth story on the other, these new customer journeys.
And the weakness is that by keeping them separate, the leap to that high forward multiple feels like two arguments just glued together.
Not one unified transformation.
Exactly. It doesn't feel like one thing causes the other, which is what you need to justify that kind of premium.
I agree. That separation really undermines the core thesis.
So the suggestion is to integrate them. Position Walmart's existing strengths, scale, data, affordability, as the actual enabler of the AI success.
The analyst does say that trust and affordability are the most important currency in this new agentic world.
They do, but they don't explicitly connect that to the valuation argument. It's a comment, not the foundation of the thesis.
So we need to see their defensive strength as the actual competitive advantage in this AI race.
Yes.
I wonder, though, if we focus too much on, say, their grocery data, does that just reinforce the old defensive value story we're trying to move away from?
That's a fair point. But I think you get around that by focusing on the quality of the data for fulfillment and AI training, not just the volume.
Okay.
The argument should be that Walmart's massive, high-trust transaction data, it's unparalleled right at the point of fulfillment. And that's exactly the proprietary moat that partners like Gemini and ChatGPT need.
They need it to make their conversational agents practical.
And profitable.
Right. This is high-fidelity, end-to-end purchasing data. Tech partners just can't get that from anyone else.
So a concrete example here would be to reframe the AI investment.
How so?
It's not a speculative digital bet. It's a way to leverage their massive existing operational moat. Right. So the high-volume, low-end consumer, the one making frequent grocery trips,
Is actually the source of proprietary AI training data that ensures the AI recommendations are super efficient and actually lead to a sale.
which justifies why Walmart is better positioned for this than, say, any other retailer. It changes the entire perception of the AI spend.
It's not an expense anymore.
It's a leverage point on an irreplaceable asset. And that is what validates the high multiple.
Okay, that makes sense. So let's pivot to the second point, the assessment of risk. We've talked about how Walmart could theoretically earn that multiple.
Now we need to look at the downside, the path of maximum pain, which I think the report understates a little.
It correctly identifies the three main fragilities. First is AI execution risk management. Even said they might build a few things that do not stick.
Second is pricing pressure.
And third is the valuation itself. There's only a 2.6% upside to the target. Very little room for error.
Analytically, that's all correct, but it kind of lacks synthesis.
What do you mean?
The weakness is that listing them as three separate things makes them seem manageable. Like you could solve one at a time. A professional investor needs to see the compounding effect.
The synergy of failure.
The synergy of failure, exactly. That's the real risk here.
So the suggestion is to map out that failure path explicitly, synthesize these risks into a defined downside scenario.
Let's call it the non-stick scenario, where the execution risk slams right into the pricing risk and forces the multiple to revert fast. It should be a guide for managing volatility, not just a list of headwinds.
Okay, so let's walk through that path of maximum pain.
Let's do it. Say the initial AI lift in those exploratory categories, fashion, auto care, beauty, disappoints in the first half of the year.
The market immediately questions the growth story.
Immediately. That lack of validation means the multiple, that 21.5x EV/beta, starts to look ridiculous. It has to revert back towards historical norms for a defensive retailer.
And that happens at the exact moment that this second fragility, the pricing pressure, is most intense.
Right. In this non-stick scenario, Walmart would probably have to get even more aggressive with price rollbacks to defend its market share.
Which would crush the projected margin improvement.
And there it is. Aggressive pricing combined with a missed growth target. That's what vaporizes the multiple.
By sketching out that specific synergistic risk, the analyst gives the reader a much better way to monitor the situation.
It becomes a stress test on the multiple itself, not just a list of concerns. It defines the point where the growth story dies.
Much sharper. Okay, our final area of focus is the forward-looking part of the report. What should investors pay attention to?
The report gives 3 points. Digitizing the in-store experience, the shift to private label over CPG brands, and monitoring basket composition.
Which are all strategically relevant.
But they lack specificity, especially for tracking those critical AI categories we just mentioned. The market has zero patience for speculative tech spend in retail right now. Zero.
So if Walmart doesn't produce tangible, proprietary metrics on the next earnings call?
The thesis goes straight into the penalty box.
The weakness then is that indicators like digitizing the in-store experience are just too broad. We need specifics. What time-bound metrics prove that this agentic shopping lift is happening where it matters most? In those high-margin exploratory categories.
We need leading indicators, not lagging financial results.
Exactly.
So the suggestion is to refine these monitoring points into clear, measurable KPIs. And we need to separate the metrics that show efficiency gains from the ones that show real incremental sales growth.
Okay, let's take the first one. Digitizing the in-store experience. That's an efficiency play.
Right.
So instead of just talking about the Sparky agent, the analyst should suggest monitoring the reported adoption rate of AI tools used by associates in the store, or an attach rate.
That's a leading indicator of internal efficiency, which is what's supposed to drive the EBIT margin expansion. That works.
What about the second point on private label innovation?
That has to connect directly back to the AI thesis.
I agree.
So instead of just watching the general trend, the analyst should specify tracking the growth rate of Walmart's private label
Versus CPG brands.
specifically within those high exploration categories: fashion, baby, beauty, auto.
That connection is critical. Why those categories?
Because if the AI can successfully sell discretionary non-grocery items, which are higher margin.
It proves the AI is a merchandising tool, not just a grocery checkout list.
Exactly. A sudden jump in private label growth in that specific subset of categories would be the first real sign. The validation that the AI is generating high-quality incremental sales and actually justifying that growth multiple.
That's a really focused, actionable KPI, an early warning signal.
It tells you if the AI is turning conversations into cash.
And finally, that third point, cohort evolution. To make that actionable, you have to split it in two.
How so?
Track the natural and organic product lift separately from the outer ring versus center store trends.
Okay, I see. The natural and organic lift tells you if you're keeping those higher income shoppers.
Right, and the outer ring trends tell you about the affordability stress on the core customer. They're two different stories. Conflating them just reduces their predictive power.
So what you're really looking for is proof that the upper income penetration is sticky and that the core consumer is at least stable.
Right. The whole goal here is to give the investor an operational roadmap. The analysis correctly identified the opportunity, Walmart's AI pivot. We're just refining the structure to support the high-stakes valuation that comes with that thesis.
So, to summarize our critique of what is really an excellent report,
The primary goal has to be giving maximum clarity on the path forward, especially with that high valuation hanging over everything. First, strengthen the narrative bridge.
Position Walmart's trust and data moat as the core enabler of AI acceleration, which is what justifies the premium multiple.
Second, the report would be much stronger if it synthesized those three fragilities into a single cohesive downside scenario.
That non-stick scenario. It sizes the risk exposure and gives a framework for managing the volatility.
And third, refine the monitoring points into clear, time-bound KPIs, specifically measuring how effective the AI is at driving higher-margin private label sales in those non-grocery exploratory categories.
That's the whole game. The strength of this thesis rests on realizing incremental, higher-margin sales from agentic shopping. If Walmart shows early data supporting a lift there, using the KPIs we talked about,
then the current 121 target is probably conservative.
Probably.
We welcome your continued contributions. If you wish to submit future analyses focusing on execution metrics or competitive response in the retail AI space, please do so.
That's how we approach research internally. Filter first, then analyze, and only then decide what's worth sharing. If you find this useful, feel free to follow the channel. I'll see you in the next episode.